Thanks for loading up this short video from LTAG on technical analysis, common questions and answers. Today we're going to look at cognitive bias. What is that and do we suffer from it? Let's get to it. So what is cognitive bias? So cognitive, i.e. something to do with the brain, the mind. We all suffer from preconceptions, biases of one type or another, and no more so than when we are investing in financial markets or indeed investing at all. We have a predisposition of various types, and those predispositions sometimes are correct and many times are not. We tend to favor things that we know. We tend to favor things where we have prior experience. We tend to lean on other people's recommendations. We tend to avoid risk, and sometimes we are influenced by social media and so many other things. But have a look at Lloyds Bank. This is the Lloyds Bank chart. It's on the daily basis. This is TradingView platform. As we've shown on other videos, there are some fundamental dates where earnings were announced, where there were dividends, and here's a future earning as well. Now, people who have invested in Lloyds Bank, it's a very stable institution, but of course it's very prone to what's going on in the economy. And prudent investors typically will wait for things to be on an upcycle and a definite upcycle before they invest. Let's say that you waited for the upcycle to come up, as it did in November of last year, and you waited for a little drop, and then you said, right, now's the time to invest. So you invested, let's say, around 48p, and typically private investors will get in much later than institutions, because institutions have better research, they have technical analysts, they have quantitative analysts who create all manner of models, and that helps them effectively get in much nearer to this point. Ideally, if you were a technical analyst, you would also get in at this point. But let's say you're a general public and you're getting it around here, which is fairly typical. The price continues to go up, you continue to be positive, but then the price turns. And not only does it turn, but then in and around this point when there's some earnings, the price is okay, not quite as good as you wanted, and the people who are professional traders sell it. And indeed sell it, and in a prior video on this channel we've talked about gaps, and a gap occurs which never then gets filled. But you as the private investor don't understand gaps, you don't understand necessarily price movements and cycles, and you continue to hold because you feel that surely Lloyds Bank has a massive institution that has an enormous balance sheet. You look at the fundamentals for the company, it looks strong, and you continue to hold. And your bias, because you know something about Lloyds Bank, forces you to continue to hold. And you're buoyed in that hope by a rise prior to some earnings. But then the market makers and those in the institutions who probably know Lloyds better than the public begin to sell it. You don't quite believe that the news arrives, and indeed it's as the institutions probably forecast, and the price continues to drop with yet another gap which was never filled also occurring. So you can see here that there's a cycle of inbuilt personal biases, a lack of knowledge of your own, which reinforces what seemed to be a good investment decision, and was for a period of time, but then became a bad decision. The reason that you need to study technical analysis is because all of these cycles, as they come down, and just take it from me on this short video, that this is a very predictable pattern, which most technical analysts would see very, very clearly. So there's a sort of a general down cycle, a short up cycle, and then a down cycle which is longer than the first. That is a very typical pattern in technical analysis, and that's one of the things that our clients learn and are able to spot. But of course, if you don't have that know-how, you're somewhat in the dark and you're left holding the baby, which is what happens to the majority of the market. And the market is generally the transfer of wealth I think it was Warren Buffett that said this, if not someone similar to him, the transfer of wealth from the poor to the wealthy. That is what happens in markets. The only way to counteract that is to have at least a modicum of knowledge of what the institutions and the bigger player have. Then you can spot cycles as they happen, and you can get out at the right time. And that really is the only way to overcome cognitive bias. Cognitive bias is so strong. Our feelings, our emotions, they're very strong, and without concrete information, it's difficult to overcome them. So invest in having concrete information, concrete facts, concrete analysis. You'll be the much better for it. So this is only a very short video on what is a massive topic, the whole concept of behavioral psychology in finance. But take it from us, it's very real, and most investors are very affected by it. You can overcome it, and the best way to overcome any issue is to have better information, better analysis. At LTAG, that's what we help our clients to have. Hope you find this useful and informative, and I'll see you in the next Q&A video. Many thanks.